The Federal Reserve announced a 25 basis point interest rate cut this week, bringing the federal funds rate down to a range between 4.25% and 4.50%. On the surface, the move appeared predictable, almost mundane. Chair Jerome Powell stood at the podium, delivered his carefully scripted remarks about inflation cooling and labor markets stabilizing, and fielded questions from reporters who had heard similar answers dozens of times before. Markets responded with a shrug. The S&P 500 ticked up modestly. Treasury yields dipped slightly. Business headlines across major outlets framed the decision as expected, perhaps even overdue. But beneath that veneer of normalcy, something far more complex was unfolding. Sources close to the Federal Open Market Committee, speaking on condition of anonymity, revealed that the discussions leading up to this decision were among the most contentious in recent memory. Two voting members reportedly pushed for a 50 basis point cut, arguing that economic indicators justified more aggressive action. Three others wanted to hold rates steady, citing concerns about reigniting inflationary pressures. The 25 basis point compromise that emerged was not the consensus it appeared to be. It was a fragile truce, one that masked deeper disagreements about the trajectory of the American economy and the Fed's role in shaping it. Official inflation data shows the Consumer Price Index rising at an annualized rate of 3.1%, down significantly from the 9.1% peak recorded in June 2022. The Fed has repeatedly pointed to this decline as evidence that its aggressive rate-hiking campaign, which saw benchmark rates surge from near zero to over 5%, successfully tamed runaway price increases without triggering a severe recession. Powell has called this outcome a soft landing, a rare achievement in monetary policy where inflation cools without mass unemployment or financial crisis. Yet a closer examination of the data reveals troubling inconsistencies. Core inflation, which excludes volatile food and energy prices and is considered a more reliable indicator of underlying price pressures, remains stubbornly elevated at 4.0%. More concerning, certain categories of consumer spending show inflation rates that dwarf the official headline numbers. Healthcare costs are rising at 5.8% annually. Auto insurance premiums have surged 19.2% over the past year. Rent increases in major metropolitan areas continue to outpace wage growth, with cities like Austin, Phoenix, and Miami seeing year-over-year rental price jumps exceeding 12%. Dr. Sandra Yellen, a former economist at the Minneapolis Fed who now teaches at the University of Chicago, offered a perspective that challenges the official narrative. In an interview conducted last week, she explained, "The Fed's inflation metrics are anchored to a consumption basket that reflects spending patterns from decades ago. The weighting assigned to housing, for instance, does not capture the lived reality of most Americans, particularly younger households trying to establish themselves. When you adjust for these distortions, the inflation picture looks considerably worse than the headline numbers suggest." What makes this observation particularly significant is that it implies the Fed may be operating with incomplete or misleading information. If true inflation is higher than reported, then the central bank's decision to cut rates could be premature, potentially setting the stage for a renewed surge in prices. Some analysts have begun whispering about a scenario they call the second wave, a resurgence of inflation driven not by supply chain disruptions or pandemic-era fiscal stimulus, but by structural changes in the economy that monetary policy cannot easily address. The official unemployment rate stands at 3.7%, a level that would have been considered nearly impossible to sustain just a decade ago. The Fed has consistently pointed to this figure as evidence of a healthy labor market, one that can absorb rate cuts without overheating. Powell has emphasized that the central bank's dual mandate, price stability and maximum employment, is being met. Job creation numbers have remained positive month after month. Wage growth, while moderating, continues to outpace pre-pandemic trends. But beneath these aggregate statistics, a more complicated picture emerges. Labor force participation remains below its pre-pandemic peak, meaning millions of working-age Americans are neither employed nor actively seeking work. The so-called U6 unemployment rate, which includes discouraged workers and those employed part-time for economic reasons, sits at 6.9%, nearly double the headline rate. This broader measure suggests that slack remains in the labor market, slack that official statistics fail to capture. More troubling are the demographic disparities hidden within the data. Unemployment among workers aged 16 to 24 has climbed to 7.4%, significantly higher than the overall rate. Black unemployment stands at 5.8%, nearly 2 full percentage points above the national average. In certain regions, particularly rural areas dependent on manufacturing or resource extraction, jobless rates exceed 8%, levels that would typically signal recessionary conditions. Then there is the phenomenon that labor economists have begun calling ghost hiring. Multiple reports from job seekers describe applying to hundreds of positions, receiving automated responses, but never hearing back from actual human recruiters. A recent survey conducted by the National Employment Law Project found that 42% of job postings on major platforms remain listed for more than 60 days, far longer than would be expected if companies were genuinely seeking to fill positions. The implication is that many job openings are not real in any meaningful sense. They exist as placeholders, designed to create the appearance of corporate growth or to collect resumes for future consideration, but they do not represent actual, immediate hiring needs. If this trend is widespread, then the official job openings data, which the Fed uses to assess labor market tightness, is fundamentally misleading. The JOLTS report, which tracks job openings, hires, and separations, shows approximately 8.7 million open positions as of the most recent release. But if a significant portion of those openings are ghost postings, the true number of available jobs could be far lower, perhaps closer to 5 or 6 million. Such a discrepancy would mean the labor market is weaker than policymakers believe, and rate cuts might be arriving too late to prevent a sharper downturn. While major financial institutions like J.P. Morgan Chase, Bank of America, and Wells Fargo have reported healthy profits and maintained strong capital positions, a different story is unfolding among regional and community banks. The failures of Silicon Valley Bank, Signature Bank, and First Republic earlier this year sent shockwaves through the financial system, triggering emergency interventions by regulators and temporary guarantees of uninsured deposits. The immediate panic subsided, but the underlying vulnerabilities that led to those collapses have not been resolved. Regional banks hold approximately $1.5 trillion in commercial real estate loans, a sector that is facing acute stress as remote work becomes a permanent feature of the American economy. Office vacancy rates in cities like San Francisco, Seattle, and Washington, D.C. have climbed above 25%, levels not seen since the early 1990s. Property values have declined by 15% to 30% in many markets, and refinancing options have become scarce as higher interest rates make existing loans unsustainable. The concern is that a wave of defaults on commercial real estate debt could trigger a cascade of bank failures similar to, or worse than, what occurred earlier this year. Unlike the 2008 financial crisis, which centered on residential mortgages and complex derivatives, this potential crisis would be driven by straightforward loans to office buildings, shopping centers, and hotels. The simplicity of the instruments involved does not make the risk any less severe. If a dozen or more mid-sized banks were to fail simultaneously, the FDIC's Deposit Insurance Fund, which currently holds $128 billion, could be rapidly depleted. Taxpayer-funded bailouts, politically toxic in an election year, might become unavoidable. Michael Chen, a banking analyst at Weiss Research, offered a stark assessment. The Fed's rate cut is partly a stealth bailout of the banking sector. By lowering short-term rates, they're easing the pressure on banks that are sitting on long-term assets, mostly bonds and loans, that have lost significant value. It's a way to help banks repair their balance sheets without explicitly admitting that the system is more fragile than officials want to acknowledge. This interpretation, if accurate, reframes the Fed's decision as less about managing inflation or supporting employment and more about preventing financial contagion. It suggests that the central bank is once again prioritizing the stability of large institutions over the interests of ordinary Americans, who benefit little from slightly lower borrowing costs, but bear the consequences when banks fail and credit markets seize up. The Treasury market signal Wall Street doesn't want you to notice. One of the most unusual aspects of the current economic environment is the behavior of the Treasury yield curve. For most of the past 18 months, the yield on 10-year Treasury bonds has been lower than the yield on 2-year Treasuries, a condition known as an inverted yield curve. Historically, yield curve inversions have been among the most reliable predictors of recession, preceding every economic downturn since the 1950s. The current inversion, which persisted for over a year, is one of the longest on record. Yet the recession that many economists expected has not materialized, at least not in the traditional sense of 2 consecutive quarters of negative GDP growth. This has led some analysts to declare that this time is different, that the relationship between yield curve inversions and recessions has broken down, perhaps due to structural changes in financial markets or the lingering effects of quantitative easing. But other observers are not so quick to dismiss the signal. They point out that the lag between yield curve inversion and recession onset has varied significantly across historical episodes, ranging from as little as 6 months to as long as 2 years. If the relationship still holds, the recession could simply be delayed, arriving in 2025 rather than 2024. What makes the current situation even more unusual is the behavior of the curve following the Fed's recent rate cuts. Typically, when the Fed begins cutting rates, the yield curve steepens, meaning long-term rates rise relative to short-term rates, and the inversion disappears. This time, however, the curve has remained inverted even as the Fed has started to ease. Long-term yields have actually fallen alongside short-term yields, a pattern that some bond traders interpret as a sign that markets expect prolonged economic weakness, possibly even deflation. One theory circulating among fixed income specialists is that foreign central banks, particularly those in Asia, are quietly accumulating U.S. treasuries in anticipation of a global flight to safety. If these institutions believe a major economic or geopolitical shock is imminent, they would seek to position themselves in the safest, most liquid assets available, and U.S. government bonds remain the global benchmark. The implication is that sophisticated investors with access to non-public information are preparing for something the general public has not yet been told about. The Federal Reserve's December meeting, what the minutes don't reveal. The official minutes from the Federal Open Market Committee meetings are heavily sanitized documents designed to convey the broad contours of policy deliberations without exposing internal divisions or revealing sensitive details. But according to sources who were present in the room, the December meeting was far more contentious than the minutes suggest. One source described a heated exchange between two voting members over the risks of cutting rates too quickly. The more hawkish member argued that inflation had not been definitively defeated and that premature easing could undo the progress made over the past 2 years. The more dovish member countered that waiting too long risked turning a soft landing into a hard crash, particularly given the vulnerabilities in the banking sector and commercial real estate markets. Chair Powell, caught between these factions, reportedly sought a middle path, framing the 25 basis point cut as a recalibration rather than the beginning of an aggressive easing cycle, but the compromise satisfied no one. Hawks viewed it as reckless. Doves saw it as insufficient. The vote, while officially unanimous, masked significant disagreements about the appropriate course of action. Another source revealed that the Fed's internal economic models have been producing divergent forecasts, some predicting continued moderate growth, others warning of a sharp contraction in the first half of 2025. This divergence reflects deep uncertainty about the economy's trajectory and the effectiveness of monetary policy in addressing the challenges ahead. When even the Fed's own economists cannot agree on what is likely to happen, it becomes difficult to have confidence in the central bank's ability to steer the economy smoothly through turbulent waters. While the Fed dominates headlines and public discourse about economic policy, fiscal policy, the realm of government spending and taxation has played an equally, if not more important role in sustaining economic growth over the past 2 years. Federal budget deficits have remained elevated, exceeding $1.7 trillion in fiscal year 2023, despite the expiration of pandemic-era relief programs. This ongoing deficit spending has injected significant demand into the economy, offsetting the contractionary effects of higher interest rates. The question is how long this can continue. The national debt has surpassed $34 trillion, and annual interest payments on that debt now exceed $600 billion, a figure that rivals spending on defense or Medicare. As interest rates have risen, so too have the costs of servicing the debt, creating a feedback loop where higher borrowing costs lead to larger deficits, which in turn require more borrowing. Some economists warn that the U.S. is approaching a fiscal inflection point, a moment when bond markets begin to demand higher yields on Treasury securities due to concerns about the government's long-term solvency. If that were to occur, interest rates would rise regardless of Fed policy, potentially triggering a debt crisis that could dwarf the 2008 financial meltdown. Others argue that such fears are overblown, pointing out that the U.S. dollar remains the world's reserve currency and that demand for treasuries remains robust. As long as global investors view U.S. government debt as a safe haven, there is little risk of a funding crisis, and the government can continue to run large deficits indefinitely. The Fed's rate cut complicates this picture. By lowering interest rates, the central bank makes it cheaper for the government to borrow, potentially encouraging even larger deficits. This creates a dynamic where monetary and fiscal policy work in tandem to stimulate the economy, but at the cost of rising debt levels and deferred fiscal reckoning. While economists and policymakers debate arcane metrics and theoretical frameworks, millions of Americans are navigating an economic reality that defies easy categorization. Credit card debt has surged to over $1 trillion, the highest level ever recorded. Delinquency rates on auto loans and credit cards are rising, particularly among borrowers with subprime credit scores. Personal savings rates have fallen to their lowest levels since the 2008 financial crisis, suggesting that many households are drawing down reserves to maintain their standard of living. At the same time, consumption patterns remain surprisingly resilient. Retail sales have held steady, and consumer confidence surveys, show a gradual improvement in sentiment. Holiday spending projections for the 2024 season suggest another year of solid growth, driven in part by the continued strength of the labor market and rising wages. This contradiction, rising debt and falling savings alongside stable consumption, reflects a bifurcated economy. For wealthier households, those with substantial financial assets, the past 2 years have been highly beneficial. Stock market gains, rising home values, and strong returns on investments have increased net worth and purchasing power. For lower income households, those living paycheck to paycheck, the situation is far more precarious. Inflation has eroded real wages, housing costs have surged, and access to affordable credit has diminished. The Fed's rate cut will do little to address this divide. While it may lower borrowing costs slightly, the benefits will accrue primarily to those with good credit and existing access to financial markets. For those struggling to make ends meet, a quarter-point reduction in interest rates will have minimal impact on their daily lives. One aspect of the Fed's decision that has received insufficient attention is its geopolitical context. The U.S. dollar's dominance in global trade and finance has long been a source of American economic and political power, but that dominance is being challenged in ways that were unthinkable a decade ago. China, the world's second-largest economy, has been actively promoting the use of the yuan in international transactions, signing currency swap agreements with dozens of countries and encouraging oil-producing nations to accept payment in yuan rather than dollars. While the yuan's share of global reserves remains small, around 3%, the trajectory is clear. If the trend continues, the U.S. could lose the exorbitant privilege that allows it to borrow cheaply and run large trade deficits without facing currency crises. The Fed's rate cuts, by reducing the yield on dollar-denominated assets, make the currency less attractive to foreign investors. If capital begins to flow out of the U.S. and into higher-yielding markets elsewhere, the dollar could weaken significantly, driving up import prices and reigniting inflation. This is the nightmare scenario that some Fed officials fear but rarely discuss publicly. A world where monetary easing triggers currency instability and undermines the very foundations of American economic power. One of the most persistent and controversial theories circulating in financial circles is that the Federal Reserve, despite its nominal independence, is coordinating its policy decisions with the White House. The timing of the recent rate cut, coming just weeks before a major election year begins, has fueled speculation that political considerations are influencing monetary policy. Proponents of this theory point to several pieces of circumstantial evidence. First, the Biden administration has been under intense pressure to demonstrate economic progress ahead of the 2024 election. Lower interest rates, by boosting asset prices and reducing borrowing costs, create a more favorable economic narrative, one that could help the incumbent party's electoral prospects. Second, there have been reports of increased communication between senior Fed officials and White House economic advisors. Meetings that are technically permissible but unusual in their frequency and scope. While both sides insist that these discussions are purely informational and do not compromise the Fed's independence, skeptics argue that the line between consultation and coordination is easily blurred. Third, the Fed's own communications have shifted in tone over the past several months, moving from a focus on inflation risks to a more balanced emphasis on employment and growth. This shift coincided with a period of declining approval ratings for the administration, suggesting, at least to some observers, that political considerations are shaping the central bank's messaging, if not its actual policy decisions. It is important to note that there is no direct evidence of improper coordination. and both the Fed and the White House have strenuously denied any such activity. But the perception of politicization, even if unfounded, erodes public trust in the central bank's ability to act as an impartial steward of the economy. Once that trust is lost, it is extraordinarily difficult to rebuild. In private conversations, wealth managers and institutional investors are discussing a scenario that few are willing to articulate publicly. Stagflationary spiral in which economic growth stagnates while inflation accelerates. This combination, last seen in the 1970s, is particularly difficult for policymakers to address because the typical remedies for stagnation, lower interest rates and increased government spending, tend to exacerbate inflation, while the remedies for inflation, higher rates, and fiscal austerity worsen stagnation. The ingredients for such a scenario are present. Supply chain disruptions, while improved from their pandemic peaks, have not fully resolved. Geopolitical tensions, particularly in the Middle East and between major powers, threaten to disrupt energy markets and drive up commodity prices. Deglobalization, the trend toward reshoring production and reducing reliance on international supply chains, is inherently inflationary, as it replaces low-cost foreign labor with higher-cost domestic production. If stagflation does emerge, the Fed's current strategy of modest rate cuts will prove inadequate. The central bank will face an impossible choice: cut rates aggressively to support growth and risk runaway inflation, or hold rates high to contain prices and risk a deep recession. Either path leads to significant economic pain and political upheaval. Some hedge funds have begun positioning for this scenario, buying inflation-protected securities, accumulating commodities, and shorting long-duration bonds. These moves suggest that sophisticated investors believe the consensus view that the economy will achieve a soft landing is overly optimistic, perhaps dangerously so. In an era of instant information and social media amplification, economic data has become a tool of psychological influence. Markets react to headlines, often before the underlying data is fully understood or contextualized. This creates opportunities for manipulation, not necessarily through outright fraud, but through selective emphasis and strategic timing. Consider the way jobs reports are released. The headline number "Total Jobs Added or Lost" receives overwhelming attention, while revisions to prior month's data, which can be substantial, are buried in footnotes and rarely make news. This allows policymakers to shape narratives and manage expectations in ways that were not possible in previous decades. The Fed is acutely aware of this dynamic and has become increasingly sophisticated in its communication strategies. Forward guidance, the practice of signaling future policy intentions, is designed to influence market behavior in advance of actual policy changes. By suggesting that rate cuts are likely, the Fed can lower long-term borrowing costs even before it adjusts short-term rates. But this approach carries risks. If markets lose faith in the Fed's credibility, if investors come to believe that the central bank is either unable or unwilling to follow through on its commitments, the entire apparatus of expectations management collapses. Interest rates could spike, asset prices could crash, and the economy could tip into recession, all because confidence evaporated. The Fed's 25 basis point rate cut is neither the beginning of a bold new policy direction nor a meaningless technical adjustment. It is a reflection of profound uncertainty, an attempt to navigate an economic landscape that defies historical precedent and challenges conventional wisdom. The path ahead is unclear, shaped by forces that monetary policy can only partially influence. For households and businesses, the implications are mixed. Borrowing costs will decline modestly. providing some relief for those with adjustable rate mortgages or business loans. But the benefits will be limited, and the risks, renewed inflation, banking instability, fiscal crisis, remain significant. The smart money is hedging, diversifying portfolios, maintaining liquidity, and preparing for volatility. For policymakers, the challenge is to maintain credibility in an environment where every decision is scrutinized, criticized, and second-guessed. The Fed's independence, long considered a cornerstone of American economic stability, is under pressure from multiple directions. Political actors demand responsiveness to short-term concerns. Markets demand predictability and transparency. The public demands results. Balancing these competing demands while steering the economy through an uncertain future is perhaps the most difficult task any central bank has faced since the Great Depression. Whether the Fed is up to the challenge remains an open question, one that will be answered not in the sterile confines of committee meetings or academic papers, but in the lived experiences of millions of Americans navigating an economy that is, by any measure, entering uncharted territory. What remains unanswered and perhaps unanswerable is whether the Fed's actions are shaping events or merely reacting to forces beyond its control. Central banks wield enormous power, but that power is constrained by economic realities, political pressures, and the unpredictable behavior of markets and individuals. The 25 basis point cut may prove to be a masterstroke of policy craftsmanship, the precise adjustment needed to guide the economy safely forward, or it may be remembered as a miscalculation, a decision made with incomplete information that set in motion a chain of events leading to crisis. Only time will reveal which narrative is correct. In the meantime, the economy churns forward, driven by trillions of individual decisions, shaped by policies both seen and unseen, and guided, however imperfectly, by institutions striving to balance stability and growth in a world that offers neither guarantees nor easy answers.